Hello and welcome to this training module where we'll discuss about bond cash flow structure. Today we will explore how issuers structure coupon payments, specifically focusing on the difference between fixed rate and floating rate securities and how embedded options like caps and floors alter the risk profile. So let's get started with fixed rate versus floating rate bonds first, and then we'll go in detail. So by distinguishing the two primary coupon, which is your fixed rate bonds and floating rate notes, often this plain vanilla bonds, like the fixed rate bond we have learned previously. Here the coupon payment never changes. If you buy a 5% bond, you get 5% every year until the maturity. In contrast, floating rate notes have a variable coupon. Their interest rate reset periodically, usually quarterly or semi-annually. This rate consists of two parts: a variable reference rate, which generally previously it was LIBOR, now it moved to the SOFR, and a fixed spread, also called the margin. The spread compensates you for the specific credit risk of the issuer, while the reference rate adjusts for general market movements. So now with what? So the question may come is why this? What this spread covers? So you can say that this is a credit risk of that issuer would be covered using the spread. So now look at the chart, which we can see here, which breaks down two main coupon types which we discussed: floating rate and fixed rate and floating rate. The fixed rate branch leads directly to a constant payments which you would continuously get and non-cash flows. So cash flow is known in this scenario and simple, predictable. On the other side, floating rate bond branch plays into two inputs. One is your reference rate, in generally this is SOFR nowadays, which moves with the market, and the fixed spread, which is like some fixed spread you would be having. We would see the example in the coming slide, which stays constant. This combines to create a payment that reset periodically, resulting in a variable payment for the investor. Now let's talk about mechanics of the floating rate notes, how that works. So now let's look at the math behind the floating rate note. The coupon formula is simple. Take the current reference rate and add a quoted margin. For instance, if you own a bond paying 6-month LIBOR plus 150 basis point and the LIBOR is currently 3.25%, your coupon for this period is 4.75%. So here also in the example same is shown here. 3.25% is the LIBOR rate currently. The fixed spread is 1.5%. So the total coupon you would get at the current situation is 4.75%. Because the coupon constantly adjusts to match current market rates, the price of the floater tends to stay very stable, hovering around its par value. This makes them very different from fixed rate bond whose price swing wildly when rates changes. So if you see the, like, this is because of this their bond price does not vary. This is also known as floaters sometimes. So now in this example we have seen, now 6 months later if you see rate drops of LIBOR to 3%. Now your new coupon would be what? 3 plus 1.5, 4.5%. So that is the risk you are having here. Now let's move to the embedded option, caps and floors, which is very critical to understand. So sometimes floater have a limit called caps and floors. A capped FRN places a ceiling on the coupon. If market rates soar or increases, the coupon stops rising at the cap level. This allows the issuer to limit their interest expense, but it hurts the investor who misses out on higher income. Conversely, a floored FRN sets a minimum floor. If market rates crash, the coupon will not fall below this level. This protects the investor income. You can even combine them to create collared FRN. So let's look at the diagram. So on the top, if you see the market rates rises, what would happen? If it is a cap, if cap scenario we consider. If it is yes, then coupon limited by cap and benefit to the issuer, not an investor. You would lose this. And there's no cap, then coupon rises fully. Basically correct. So whatever there's no limit on the higher side of the coupon, which is good for the investor. Now another scenario where market rates fall and assume it has a floor. Yes, it has a floor, then coupon held at a floor. So it cannot go, your coupon cannot go below certain limit, which benefits the investor. And If there is no flow, then coupon can fall fully, and which harms the investor. Now let's move to the next, investor floating rate notes, inverse floating rate notes. Let's go with detail. A more complex structure is the inverse floater. Here the coupon moves in the opposite direction of the market. The formula is usually a high fixed rate minus the reference rate. If the market rates go down, your coupon goes up. This is popular with investors who are very confident that rates will fall. However, this often includes leverage, meaning the coupon might change by double or triple the change in the market rate. This magnifies the gains but also magnifies the losses if rates are rise instead of fall. Okay, so we'll discuss in detail later. Just a concept we want to introduce. Now moving to the step up and deferred coupons. What does that mean? Let's touch on two other variations. A step up coupon bond starts with a lower rate that increases or step up at a specific future dates. This protect investors from holding a low yield bond forever. Often issuers will call or pay off the bond just before the step up to avoid paying the higher rate. A deferred coupon bond, sometimes called a split coupon bond, pays no interest for the first few years. The interest accrues and is paid later. This is useful for issuers who need to save cash immediately, perhaps to fund a project, but can afford to pay more later. So this also shown in the diagram. For example, if you see here, the life of a step up bond, the initial period the investor receives the low coupon payment and issuer is happy with the low cost in this scenario. As we approaches the step up date, correct? This is the step up date. As soon as you approaches, the rate jumps high. This triggers the issuer to call the bond to avoid the expenses. The journey ends with the investor being paid principal, showing how the structure forces an early exit in this scenario. So let's summarize what we have learned and how interest rate risk we can compare across this different type of bonds. To wrap up, the choice between fixed and floating comes down to a risk. Fixed rate bonds carry high interest rate risk, also known as duration risk. If market rates rise, the fixed price falls significantly. Floating rate notes have a very low duration risk because their coupon adjusts accordingly. The price usually returns to par at every reset date. However, both are subject to credit risk. If the issuer gets into a trouble, the price will fall regardless of the coupon structure. So we learned that the fixed rate bonds offer stable income with volatile pricing, while floaters offer stable pricing with volatile income. The important point is matching the structure to your view on future interest rates. So this is very important concept. You need to understand that. Let me repeat it. While so we learned that fixed rate bond offers stable income with volatile pricing. This line you need to remember. While floaters offer stable pricing with the volatile income. Now let's go to the pie chart which we have here, which dramatically illustrates the difference in the interest rate risk or duration. The large slice represent fixed rate bond risk, 90% here, correct? So interest rate risk is high for the fixed rate bonds. It makes up the vast majority of the price sensitivity to rate changes. And the tiny slice represents the floating rate bonds, only 10% area, visually confirming that floaters have a minimal sensitivity to interest rate movements compared to their fixed income counterparts. So that's all. Thanks for watching. I hope you like this session. I'm stopping now.